Okay, everybody. Thank you for tuning in, joining us today, watching on LinkedIn, YouTube, wherever you may be. we we do appreciate it. We hope that you find these series beneficial and maybe you pick up a few tidbits. That's always our goal. That you've got at least one thing that you can go back and have a better understanding or plug in and utilize in your organization. I'm joined again today by Bob. How you doing today, Bob?
Great, Davey. How about you?
Doing well, thank you. So,
Good.
Bob, we last time we talked through EBITDA, we talked through contribution margin, and today we're going to dial it back a little bit and really do a financial statement. So 101. Let me kind of walk us through what the day is going to look like here. So we're going to start with the simple definition of a statement, why we need to know what's on the statement. We're going to talk about GAAP, what that stands for, what it means to us. And then we're going to go through the different statements, the statement of earnings, also called the income statement, the balance sheet, cash flow statement, audits, reviews, compilations. And then we'll again touch on EBITDA and contribution margin, how those relate to the financial statements. And like I said, try to give you some key takeaways that you can utilize right away inside your organization. All right, so first thing, what is a financial statement? Well, in its simplest form, it's just showing you where the money came from, where it went, and where it is now. And we do that using three standardized documents, which is the statement of earnings that you'll also hear referred to as an income statement, the balance sheet, and the cash flow statement. And, their names are pretty self-explanatory here. So your statement of earnings shows your earnings through a specified period of time. All of these statements are going to be for a specific period of time, either looking at a month, a year, a week, whatever it may be. And then your balance sheet. So your balance sheet is what you own and what you owe at a snapshot in time. If we click the shutter on the camera, what do your accounts look like right now? What is yours and what do you owe elsewhere? And then the cash flow statement. And it is just that. How does the cash come into the organization and flow back out? So we've got a few items to go through here before we get into the actual statements themselves. We're going to talk about GAAP, which is a standard that Bob will talk through more for us here in just a second. We'll talk about internal versus external statements, so what the differences are and who might use which one. We'll talk about the benefits of percentage analysis, different comparative analysis, and then we'll also mention what notes are when you hear someone refer to notes on a financial statement. So, Bob, go ahead and tell us about GAAP.
Sure, glad to do that. So GAAP, and you'll notice it's spelled with two A's, is generally accepted accounting principles. And those are set by what's called the Financial Accounting Standards Board here in the U.S. And that's really all the principles and rules that govern how financial statements are created, what's income, what's revenue, what are all the different components and how they're explained and presented. It's the source for all the accounting guidelines, basically. So it's sort of the rules of the road. These have evolved over the years. During my career, when I first started, GAAP was more what we called principle-based. It wasn't so specific on individual rules, but over these last years, it's become much more rule-based. There are rules for different industries. There are specific rules, particularly on leases and pensions and how they're recorded. We've just had some new pronouncements come out about revenue recognition, and that's changed over the last several years on how revenue is recognized, particularly in different industries. So it's the rules of the road. And it's more rules-based now than principles. Used to, we were able to have some flexibility in how things were interpreted because CPAs were expected to apply professional knowledge and expertise to a principle-based system and then develop financial statements. But it's much more specific and rule-driven now. IFRS, or the abbreviation IFRS, International Financial Reporting Standards, that's really now gone back to more principle based. That's what countries internationally are using now, and it's much more principles. And so the U.S. is in this transition period now where we're trying to get away from so many specific rules and go back to principles. That's a hard transition for us because we've been going the other way for the last 25, 30 years. But that's where the entire world is going, and the United States is trying to modify its standards to get there as well, for the simple reason that so much business is conducted globally now. And so to make financial statements comparable across countries and across countries that operate, companies that operate in multiple countries, we're trying to get to a common set that everybody in the world identifies with. So we're not there yet, but we're headed that direction. But today, all correct accounting currently comes from US GAAP. The international standards will have much less impact on privately owned family businesses in the US that aren't traded publicly, that aren't doing international work. There's even talk of a big gap, little gap for small privately held companies versus large. Don't know where that argument will end, but that's the general backdrop. Today, we're following generally accepted accounting principles developed in the US. That's the guideline we go by.
So when someone hears their CPA or their accountant or bookkeeper, talk about depreciation methods and FIFO versus, another method, is that all stemming from GAAP standards?
Yes, all of those things are. Virtually everything inside accounting is defined under GAAP. So we can't go off and do things that we think make logical sense if there's a GAAP rule that says, no, that's not the way you do it. So we are constrained within GAAP, but GAAP touches almost every topic in accounting.
I see. All right. Well, next up, we've got internal versus external statements. And when we call it internal versus external, we're really referring, Bob, to the audience that it's intended for. Whereas internal is going to be much more detailed. It gets down to a nuts and bolts granular level view of what's going on in the organization. And it's going to be very helpful for managing the day-to-day aspects, the managerial operation of the business. Whereas an external statement, it's the same data, it's the same end result, but it's going to be at a higher level, something that you could show to an investor, to a bank, to a third party that doesn't really need to get down in the nuts and bolts of your inventory, but just needs to have a larger picture. Am I explaining that right, Bob?
No, that's exactly right. If you'll think of it as external statements have to follow GAAP. Anytime a company is releasing statements to third parties, whether it's the bank or their stockholders or whoever, they have to follow GAAP. Unless they have a specific exclusion. For instance, if somebody's solely on the cash basis of accounting. Some small businesses and startups use the cash basis, but most graduate to GAAP pretty quickly because that's what the banker and other external users want to see, because that's what they're used to seeing on a comparative basis. So the external statements have to follow GAAP, but you're exactly right. The internal statements, even though we'll follow GAAP, will make some departures, such as we may not provide the notes to the financial statements that are required under GAAP in an external release. It will be more detailed. We may have 30 line items about our inventory where those may be summarized into one line item on the external statements. People have to remember, and this is sort of an unusual concept, but financial statements, when what we call modern accounting began about 500 years ago, statements were developed over that period of time to tell people outside the business about the business. And the last 100 years have been really pointed toward those external statements, but not toward the internal management of the company. So it's as you said, it's two different audiences. People who are making investment and lending decisions about the company really need different information than those that are running it every day. Now, there's some overlap, but the internal statements help us to make managerial decisions day to day. The external statements really emphasize what's happened in the past at a high level, and do I want to invest or lend to that company?
Well, just like, internal and external statements, I think our next two slides here talk about using the statements for an internal analysis, comparing yourself against yourself, maybe a year over year, month over month comparison, versus an external analysis where we're comparing it against your competitors or against the market as a whole.
That's right. Both audiences, internal and external, like to do comparative analysis, but some of that comparative analysis is different. For instance, external users definitely want to measure these period over period adjustments, whether it's month to month, year to year, quarter to quarter. Internal analysis likes to compare to a specific budget or plan. Most internal users say the past is the past. What do we think we're going to do this year, and how close are we to doing that? Both across all the statements. So internal usually compares to a specific plan. External tends to compare to prior periods.
Okay, we've got. All right, and lastly, Bob, we've got the notes for a financial statement, and notes are exactly that, exactly what you'd think a note is. We've got a note that's actually listed on the statement itself to give a further or a better explanation, help the user understand and process the data that they're seeing.
That's right. And normally on internal statements, we don't provide notes. Those are usually just annual on the external. And it's really because internally, we either know what those notes are anyway, or they only apply sort of once a year. They're sort of summaries of things that we do every day. So the external notes are for the external users, describe those things that are higher level and things they need to know as, what are the depreciation methods? How is the inventory value? What is the basis for consolidation if we have multiple entities involved? So it really gives a lot of background and good information to an external user that they wouldn't have otherwise. And it really helps explain the numbers better and provides additional information that's not necessarily required on a day-to-day management of the company. So we have to remember, externally, the notes are as important as the numbers. They really go hand in hand to tell the story. But internally, we're worried more about the day-to-day operation where the notes aren't as critical. But certainly to an external user, and I tell people all the time, read the notes. They're important. They give you a lot of information, and they support what the numbers tell you as well.
Okay, well, let's go ahead, Bob, and let's take a quick break. And then when we come back, we'll start with the statement of earnings and look at an actual example.
Sounds good.
All right, Bob, we're back. And the first statement that we're going to talk about as we go through our Financial Statements 101 is the statement of earnings. Now, people may have heard this referred to as an income statement, a P&L, a profit and loss statement. But correct me if I'm wrong, the proper technical name per GAAP is now the statement of earnings.
That's correct. And this statement has evolved in time in formatting, in the exact information presented, and in name as well. P&L is the oldest name of what it's called. You'll hear certain people call it P&L or profit and loss statement. Then income statement was the term for about 25 or 30 years. And now lately, statement of earnings is a technically correct term. But internally within your own company, you may have people that call it all three. So all are acceptable, but the formal name is statement of earnings.
Well, I tell you what, we're going to jump in, Bob, and watch this little Investopedia video, which just it's a great website, by the way, folks, if you've never visited Investopedia for a multitude of items. But it does a good job here in just a couple of minutes of giving us an overview of our statement of earnings.
The income statement is a report that measures a company's financial performance over a specific accounting period. This statement is also known by a number of other names: profit and loss statement and earnings statement. Publicly traded companies must produce income statements along with balance sheets and cash flow statements for each quarter and each year in accordance with generally accepted accounting principles. The income statement shows a company's revenue, expenses, and net profit from both operating and non-operating activities. It lists the company's net sales, cost of sales, gross income, selling, general and administrative expenses, special or extraordinary items, and other income and expenses, which then reveals the company's gross profit, operating profit, pre-tax profit, and after-tax profit. The income statement is divided into two parts: the operating and non-operating sections. The operating section shows the revenues and expenses associated with the company's regular business activities. In the non-operating section, the company reports any revenues or expenses not directly related to its regular operations, such as the sale of investments. Generally, investors look to the income statement in hopes of seeing an increase in revenue or net sales and a decrease in expenses. The less money a company has to spend and the more money it earns, the more profitable it is.
Okay, Bob. So we've seen the video now. We've got the highlights. We're looking at what appears to be a very simplified income statement or statement of earnings. Why don't you just walk us through these handful of line items here and exactly what we're looking at?
Sure. And by the way, great video. I think that's a very, very informative. But this is called a comparative statement of earnings because we're comparing different years. We're comparing in this one two is the most common, current and one prior, but in this one we're comparing 3 years, which is good. And this shows just the major items. If you go to and look at a 10K filed by a public company quarterly, this income statement is going to have 150 line items on it. It's just more detail. This one has all the basics. So don't be afraid to look at public company statements. They provide great information and they have great formatting. They have very highly qualified people that spend hours and hours making these statements correct. So don't be afraid to look and learn at those. But for a simple example, this is a great one. It shows the revenue for the year, the cost of goods sold or cost of goods manufactured. That's the direct costs that are incurred to either manufacture the product or deliver the service. And then we have a gross profit, which is the difference. Gross profit's a key number for most businesses. It's easy to compare by industry. It's easy to compare with prior years. Often we see these with percentages because sometimes percentages are easy to compare. This one shows total dollars, which is fine. Then we get into the more fixed expenses: salary and benefits, rent and overhead, the non-cash depreciation and amortization, the interest expense, which people are always interested in because financing cost is important, total expenses then after gross profit, and then earnings before tax. And then simply here, our taxes, and then our net income or net earnings. So those are all the key aspects on an income statement. It tells us a tremendous amount about the company. The gross profit's highly important. The fixed expenses are important. The pre-tax number is important because different entities have different tax structures. So many investors like to measure a company before and after tax because they may have different tax strategies, different entity statuses that impact that number. As we go on a little deeper, we'll explain why that's even more important a little bit later. But this shows that the company's revenue was steadily increasing and their earnings were steadily increasing as well. So it starts to look like a growth company.
All right, Bob, well, you alluded to percentage analysis just a second ago there, talking about gross profit percentage. But, you know, you can look at that percentage and the percentage of change with any line item on the statement.
Well, that's exactly right. And whereas on the previous screen, everything was related to revenue, what's the percent of revenue? This one, as you said, is a percentage change from the previous year to last year. So here we see we had a 21% sales increase, and our gross profit had a 25% increase, which is favorable. That means our gross profit is growing faster than our revenue, which implies at least that our variable costs are under control and our fixed costs that are within cost of goods sold, we're starting to overcome that now. We're above break even. We're getting the advantage of more sales, more product and maintaining a level of fixed costs. So our margin should go up more than our sales increase. So that's favorable. Salaries went up 5%. That's, in this day and time, that's considered a pretty normal increase. Probably had a new hire or two in there. But if you look at our utilities, they're up 33%. That's pretty significant. And then our bad debt provision, which is our ability to predict and say, some of our customers may not pay us. Maybe we've got too aggressive a sales policy. We're selling to B and C customers rather than A customers. That's increased 33%. Now, in this example, we're not talking big numbers, so that has to be in relation to. So the percentages have to be 33% increase. It was $500. You have to compare that relative. Okay, is that meaningful to the business or not? So, and then we have the other expenses as well. So our net income, though, very favorable, 69% increase over the prior year. That's certainly the direction we like to see it, and that's pretty aggressive. That's pretty strong movement in 1 year. Granted, it's a smaller company, maybe a startup, maybe they've only been in business a year or two, so the percentages look a little inflated, but it's going the right direction. And this is a common scenario. This looks real to what we see every day.
All right, we've got Dwight on here to get the point across. The income statement is a representation of money that you have earned, although you may not have yet received this money. Bob, this can be a really tricky concept for people to grasp, but explain to us in layman's terms what it means that we've earned that money, but we haven't received it yet.
Sure. In order to make things comparative, one of the GAAP rules is called accrual accounting. So we record revenue when it's earned, and we record cash when it's received. And we do that throughout all the accounts. So for instance, if you sell something to somebody today, but they're paying on time, on terms that you provided, then it's revenue today, but you may not receive that cash for 45 days, depending on your collection practices and your extended terms. Consequently, when you pay a vendor, you order it, receive the product, the vendor product today. Okay, that's an expense today, but you may not pay for that expense for 30 days based on the terms they've given you. So the cash and the earnings have what we call timing differences. So receiving the cash and paying the cash out is a timing difference. Then there are permanent differences, such as non-cash transactions, such as amortization and depreciation. Those are always going to be expenses, but they don't represent cash out of the business. So you may have bought a piece of equipment 2 years ago and you're depreciating it. The cash may have gone out 2 years ago, or you may be paying for that over time, over a 5-year period. So that cash expenditure is different than the booked depreciation expense. But that's a permanent difference versus a timing difference of accounts receivable and accounts payable.
Well, sounds good. Well, that wraps up our statement of earnings, and we'll take another break here, Bob. And when we come back, we'll jump into the balance sheet.
Sounds great.
Okay, we are back, continuing on talking about financial statements. And up next, Bob, we've got the balance sheet, which, as we talked about as we started the presentation, is really just a snapshot of what you owe, or what you own, and what you owe at a period in time.
That's correct. The balance sheet is technically the most important of the three statements. Most people intuitively would say that's the income statement or the statement of earnings because it gives all this detail. But the bottom line of the income statement is summarized on one line of the balance sheet. So your statement of earnings is summarized in one line on the balance sheet, but then you have all this other information at a point in time, or as you like to say, the snapshot, which is 100% correct, and shows us all of our assets, liabilities, and equity in addition to the earnings that we've made during the period.
Well, we've got another good little Investopedia video here, so let's watch through that, and then we'll come back.
Sounds good.
A balance sheet is a statement of net worth. It's broken up into three sections: assets, liabilities, and equity. A equals L plus E. Meet Joe. Joe goes to the bank and gets a small business loan. The bank gives him cash. On the balance sheet, his liabilities increase by the size of the loan and his assets increase by the same amount. The balance sheet remains in balance. Joe uses the cash to buy a truck and start his own pizza delivery service. His cash assets decrease, but that's balanced by an increase in his other assets, a new truck. As Joe delivers pizza, the profits are recorded in the balance sheet as retained earnings in the equity section of the balance sheet. The cash from his profit is recorded in the assets section, balancing out. Every month, Joe makes a payment against his loan. He reduces his liabilities by the amount of the payment, and his cash is reduced by the same amount. To find out his business's worth, Joe subtracts liabilities from his assets. This equals the net worth of his business.
Okay, so that was, again, a really great little abbreviated explanation of the balance sheet there. And now, again, Bob, we've got an example here, a real-life example with the line items. So take us through this balance sheet we're looking at.
Sure. Once again, it's a comparative statement. It shows 3 years, 17, 18, and 19, which is good. You can start to sort of in your head get some trend analysis going. But the balance sheet shows the important elements of our snapshot: how much cash we have, how much is our accounts receivable, what customers owe us, how much inventory we have on hand at a point in time, and what's our net property and equipment value. Now, accounting is based on, in this particular instance, based on historical cost. So it's what we paid for that property and equipment less the accumulated depreciation to date. That shows the net number. And then we have our total assets. If you see over time, 17, 18, and 19, that our total assets have increased. Our cash balance has increased. Our receivables are about the same, slight increase. Inventory's increased a little bit. Property, plant, and equipment have gone up. Now, what that tells us, though, is depreciation, accumulated depreciation, would bring that balance down. So we know just by looking at this that means we've been purchasing property and equipment over this time period as well. So the net balance is increasing, even though we know a component balance is decreasing. So we've got both factors at work. Our accounts payable is pretty tight. We don't have much that we owe vendors. We'll come back to that in a later section and say maybe that should actually be higher, which is sort of counterintuitive that we would want to owe people more money. Our debt has decreased. Apparently, we paid $20,000 down in 19, brought it down from 30 to 10. Our equity capital remains the same, but importantly, our retained earnings have increased. So our profit that we've earned that hadn't been distributed out of the business is still retained in the business. So that means it hasn't been paid out. However, what's confusing to people sometimes is, well, do I have $207,000 sitting in the bank? Well, in this case, we have $328,000, which is very positive. But our cash balance can be different than our retained earnings because we've reinvested in the company. So we might not have very much cash. We might have positive retained earnings, but we've invested that in receivables and inventory and property and equipment. So
Sure.
Therefore, our cash balance isn't as high, but we funnel that money back into the business and haven't paid it out to ourselves in the form of distributions or dividends or profits.
Well, again, we talked about with the statement of earnings about different forms of percentage analysis. And of course, we can do the same thing with the balance sheet. You know, we've got the little thought bubble here of, how much inventory do we have as a percentage of total assets? And Bob, often when you're talking about assets, like you were just alluding to, we look at it as a percentage of the total assets.
Yes, and that's very helpful. We see that our cash balance has increased, and as a percentage of total assets, it's gone from 6.4% in September of 16 to 7.1% in September of 18. So that just simply means that as a percentage of our total assets, our cash balance is increasing. Your thought bubble at inventory, we notice our inventory has increased from 2,000 to almost 4,000. So it's gone from 0.7% of the total assets to 1.1%, which means as we're growing our balance sheet, a higher percentage of that is taken up in inventory. So our current assets, which are important, are almost 36% versus 33% 2 years ago. And if we look further, our long-term investments are declining in the business in this example. But if we look at our long-term assets, they're 64% versus 66% 2 years ago. So it shows us how we're investing in our own business and how those percentages are changing. What's also important is, what did we expect them to change? And even though a budget and I like to call it a plan because it encompasses more than just the numbers, it's the marketing strategy, it's the investment strategy, it's the employee strategy. How do we compare back to our plan? And I think that's critically important for particularly family-owned businesses, smaller privately held businesses. We may not achieve the plan in its entirety, but how close are we, and what sort of mid-course directions do we need to make as we go through the end of the year? This kind of analysis helps us do that.
Well, wrapping up the balance sheet, Bob, we've got what's known as the accounting equation here, and anyone who has taken any type of accounting course at just about any level has probably heard assets equals liability plus owner's equity. But here it is in real life on the balance sheet.
That's right. One of the first things I always look at is to make sure someone's balance sheet is in fact in balance. And there's a certain percentage when I look at that aren't in balance. They've had some sort of IT problem, some sort of accounting problem. So that's always the first thing I look at, to make sure that that's in balance. And if you remember the old math, assets minus liabilities also equals owner's equity. So it works either way, but what you've got on there is the traditional format, and that should always work. If there's an error if that equation doesn't hold true.
Well, I think that takes us through the balance sheet, Bob. We'll take another break here and come back and continue on with our cash flow statement.
Sounds good.
Okay, continuing on, we are back and going through our third and final portion of the financial statement here, and that is the cash flow statement. And cash flow statement, as you might guess, it is exactly that. It shows the cash as it flows into your business, where it goes, and how that cash is then used and flows back out of your business. And Bob, cash flow is divided into three areas: operating, investing, and financing, that we're going to take a look at here in just a second. And also, there's a couple of different methods, direct and indirect method, for how you go about creating that statement. But at the end of the day, they're all coming to the same end result. Is that correct?
Yes, it's just different methods of how you get there. One of our bullet points is pretty critical. It reconciles cash to GAAP earnings, which we talked about at the beginning of this, that cash earnings and GAAP earnings are two different things for most businesses most of the time. So this reconciles that difference. The cash flow statement itself can be a little confusing. Most accountants don't like it because it's a little bit difficult to put together. But for our people here in Financial Statements 101, if we just keep in mind, let's look at this as at an upper level. You're not going to be the one that's putting it together, but you're trying to gain understanding in the business. This is different than a cash projection. It's different than a 13-week cash flow that you'll hear bankers talk about, and maybe your CFO or controller or CPA talks about. But this is the actual GAAP cash flow statement that basically shows, as you said, the inflow and outflow for operating, investing, and financing activities. So take that high level approach and you'll be good.
Okay, well, as we alluded to, you do have 3 sections on the cash flow statement. And this, when we talk about operating, investing, and financing, that refers to how that cash was generated.
That's correct. The operating is just simply as you would imagine. It's the cash flow that's come in from our revenue that we've generated when we've actually collected. It's all those operational expenses like rent and utilities, inventory, payroll, all those things that that are used in the day-to-day operation of the business. That's the first section. The second section is investing. So if you'll think of it as, it's how do we invest in the business? So we're buying equipment. We're doing facility upgrades. We've invested excess cash in some sort of other marketable investment of some kind. So that's how we've reinvested in the business. And then the third section is simply financing. How do we have this business financed? Did we borrow money? Did we pay back money? Did we pay interest? Did we pay principal? Did we pay dividends to shareholders? Did we distribute excess earnings back to the owners of the business? So the 3 major sections: how do we operate day to day? How do we invest in our own business? And how is the business financed? That's the 3 pillars of the cash flow statement.
Well, let's go ahead and go forward and look at an example here. And as we can see on this cash flow statement, Bob, there's the 3 sections you just talked about.
Exactly. So, and this is a good comparative statement. It shows 3 years, so it doesn't matter what year we're talking about. Let's just talk a little bit about the mechanics. So we start with net earnings. Now remember, that's the GAAP net earnings of the business after taxes, everything. That's the earnings we start with. So we add back those items that are non-cash, depreciation and amortization that we mentioned before, non-cash items. So we're going to add those back to our earnings as we drive toward our cash balance in the business. Then our changes in working capital. So that's, did our receivables change? Did our payables change? Did our inventory change? All those items in our net working capital that changed, and on an expanded statement, you would see each one of those listed. We've just consolidated that into one line for the simplicity, but it's all those changes in operations, and that gives us the cash generated from our operations, our earnings, our add backs of non-cash items, and then our changes in real cash items, such as AR, inventory, and accounts payable. Then we go to the next section. How did we invest in the business? So in this particular example, we're investing in property and equipment every year. So that's going to be a reduction of our cash because we're reinvesting cash into the business. And then in our financing section, only in 2019 did we have anything, but we repaid debt. If you remember back to the balance sheet, we saw that. We saw that there was a debt repayment where it went from $30,000 to $10,000. Here's that $20,000 difference in 2019 shows up as a reduction in the debt. So then those are just all summed, and it shows our net increase or decrease in cash. Fortunately for this business, there was still a net increase in cash. Then we compare that to what we started with, and now we have our closing or ending cash balance. So this business, because it has healthy earnings, it has a depreciation to add back, so it generates significant cash from its operation. Its investment in property and equipment is not major. They're replenishing equipment every year, and then they're repaying debt as they can. So this is an ideal cash flow situation. They're reinvesting in the business, paying down debt, and still have surplus cash. You see their cash going from 274 to 317, all the way up to 328 at the end of 19, which ties back to our balance sheet in each of those years.
All right. Well, you know, Bob, we alluded earlier that there's a couple of different ways to skin a cat, and that's definitely true here with the cash flow statement. So we've got the direct versus the indirect method. Tell us what the difference is in that, and which method will commonly see used in business today.
Most businesses today use the indirect method because simply as we went through it, it starts with the GAAP earnings and works its way to cash earnings. And it lays out in the 3 pillars. So that's actually the easiest to understand, and it does its reconciliation there directly on the face of the statement. So we're reconciling from GAAP earnings to cash. The direct method does it a little bit differently. It's not as commonly used, a little bit harder to put together, a little bit more confusing in its presentation, gets to the same result at the end of the day, does a separate GAAP to cash reconciliation at the bottom of the statement, whereas this is integral to the statement. So for those reasons, the indirect method is what most people use today.
Gotcha. Okay, well, as we wrap up the cash flow statement here, what's the takeaways that people can, if they see a cash flow statement, maybe they get one that floats across their desk in their company and they sit down and they look at it, how can they, based on what they've learned here today, just very quickly get an understanding of what they're looking at and see the different sections on the statement?
Sure. If you look at that operating cash line, that says, are we on a day-to-day basis generating positive cash in this business? That's the first thing to look at. So in this example, cash from operations in 17, 49,000, 52,000, 56,000. That says, yes, we are generating positive cash on a day-to-day basis in the operation. That's the first thing. Then we want to go to the investment section and say, are we investing back in the business, and how much relative to our positive cash flow that we have from the operation? And then financing, are we borrowing money? Are we paying money back? Have we generated enough cash to pay back debt? Is that our intent? Or are we having to borrow more money? Are we borrowing money to reinvest in the business, which is often a good thing? Or are we borrowing money because we're trying to stay afloat? So if you look at those 3 lines, cash from operations, cash from investing, cash from financing, that sort of tells you in a snapshot, am I generating the cash that I need, and how am I spending it? Reinvesting in the business or refinancing the business? And then, of course, it's just the math at the end. Where did we start? What was our net generation of cash, and where did we end? So that's sort of the key lines to look at an upper level.
Okay, folks. Well, we wrapped up that last section talking about the statement of cash flows. And now, Bob, we've got up here on the screen, I've got audit, review, and compilation. Take us through the differences, the similarities here, and what we need to know about each of these processes. Sure.
For most companies that have an outside CPA, they're going to get one of these 3 reports. And they cost different, they provide different information. So it's helpful just to understand at a high level what they all mean. Okay. But the audit is performed by an individually state licensed CPA, usually in a firm. Sometimes it's a solo practice. And it's to express an opinion, a professional opinion on the financial statements taken as a whole. So using all of the GAAP, all of the audit guidelines, a CPA is going to come in and review everything and then express their opinion about whether or not these financial statements are materially correct or not. Now, it's not a fraud audit, it's not a guarantee, but it's their professional opinion about whether or not the financial statements are presented fairly.
And Bob, is that something, I think a lot of times we hear clients that maybe they're applying for credit or for a new lease on a building where a third party will ask them to provide an audited set of financial statements. So that's what we're referring to here?
That's exactly right. And most businesses, when they get to a certain size, and it can vary by industry, but most businesses, when they get to $10 to $20 million in revenue, their lenders are asking for audited statements because they want assurance that a professional has reviewed these and they are in fact materially correct. So that's the highest level. That's the highest level of engagement for a CPA firm. The next level, the middle level, is a review. and as we say here in our little bullet, follows the AICPA standards to provide limited assurance as a basis for reporting on material modifications to financial statements. So it's not quite the level of an audit. They don't study and evaluate internal control. They review that, but it's a less expensive, you could say less invasive. It's not as time consuming, but it gives limited assurance. Many companies, as they're growing, will graduate to the review stage before they get to the audit stage. And this is many companies have reviews. So there's nothing wrong with the review, but it's limited assurance as to a more in-depth study. And finally, the lowest level, the least expensive, is a compilation. And that takes the financial statements that management has prepared, follows all the AICPA, which is the American Institute for Certified Public Accountants, those standards, and puts it into GAAP format, the financial statements that management generates, without expressing any opinion or providing any assurance. So what that does to a banker or an outside investor is it puts it in the format that they can compare with other companies, but it's always management's financial statements without the independent review or independent audit. So it's just a dressing up of the financial statements so that it's in a comparable format.
And, you know, if anybody's seen any of our previous videos, they've heard us talk about EBITDA before, Bob, earnings before interest, taxes, depreciation, and amortization. But we've got a real life example here from an income statement where you can see just exactly what EBITDA is and how you can determine that from your financial statements.
Yes, and I'm a big EBITDA fan because, and I think you have a slide on this that says, it's the theoretical cash flow generation ability of the company. And that's its value, is that it says this is the amount of cash flow that this company, holding the balance sheet constant, should be able to generate. It takes out all those non-cash items such as depreciation and amortization. It takes out the interest expense. It takes out income taxes because, as we've talked before, interest expense is a financing choice. Some companies want to have a lot of debt, some want to have none. It takes out income taxes because companies can be established in various ways. They can have different entities. They can be LLPs, LLCs, C Corps, S Corps, sole proprietorships, partnerships. Those taxes are all different. Some are flow through entities. So it takes that out of it as well and says, what's the real cash generating a business ability of this business? Many investors use this. We say smart owners do as well, because if that's how an outside person looks at your business, you ought to be looking at it as well. Adjusted EBITDA, which is another level, adds back expenses that are one-time in nature. Often in an M&A transaction, merger and acquisition, there are one-time expenses. So it takes those out of it as well. So it's truly comparable. So EBITDA and EBITDA growth is critical for successful companies. They want to be growing their EBITDA each and every year. So that's why the emphasis and why it's so important.
Well, right along with EBITDA, Bob, you know, we've talked in the past about contribution margin. And I tell you what we're going to do right now is let's pause this and we'll jump in the time machine here, go back in the archives. And if you haven't seen it before, here's a little walkthrough on contribution margin.
Yes. I'm a firm believer in contribution margin. Most of our clients are not familiar with this concept when we first introduce it, but it makes intuitive sense to them once they understand and we're able to explain it. It's really an old formula. It goes back many years. Manufacturing companies were the first to really explore this, but now it's into retail, it's into technology, it's into service businesses. And it's really a way of looking at how much profit do I make on the next dollar or next unit of revenue that I can achieve. So that's a very important to know that amount, because it allows you to then make better business decisions when you know how much you're going to keep or invest from that next dollar of revenue.
Now, when I hear contribution and I hear margin, Bob, generally, we hear about the net margin, we hear about the gross margin. How does contribution margin compare with those?
Sure. Contribution margin is further up. It's not directly shown on the income statement unless you have a set of internal statements that itemize that, and we often do that with clients. But it's simply the revenue minus the variable cost. And you have the major variable costs listed here: direct material, direct labor, any kind of direct outsourcing, commissions, something that people don't think about sometimes, but commissions are normally on a variable basis based on the revenue, the sales, or sometimes they're paid after the collection of that. And then any other cost that changes when revenue changes. But none of your fixed costs, not rent, not insurance, not fixed salaries, none of those costs apply at this point. We're simply looking at, if I sell another unit, or I have another $1, $10, $100, $1,000 of revenue, what changes to help me generate that? And it's material, labor, outsourcing, commissions, and maybe some other smaller expenses that vary with revenue.
I see. So if I sell 100 widgets or I sell 1,000 widgets, my rent is not going to change, right? I'm paying the same rent for my warehouse, but the cost that it took me to manufacture those widgets is going to change. Is that the difference we're talking about here?
That's exactly right. And maybe you're not a manufacturer. Maybe you're a wholesaler or a distributor or a retailer. So it's what you paid for that widget or whatever that item is that you're selling. What additional labor did you have to put into it to finish it or convert it to its final use? Did you outsource any of that, or did you do it all internally? Did you have to pay a commission on it? So yes, it applies across all businesses. Even professional service companies use this. We see attorneys and accountants, engineering companies using this kind of analysis to understand their business better. But you're right. All those fixed costs stay the same. We're only interested in variable at this point.
Well, let's look at an example of contribution margin. So we've got a drill here. We got a DeWalt drill. Says selling price is $100. I don't see many DeWalt drills for $100 now. Seems like they start at about $200. But anyhow, that's a different conversation. But let's look at these numbers and how the contribution margin for this drill, this item that is being sold or manufactured, is being factored. So we've got some things up top here. We've got direct material, as you referenced earlier, piece rate labor. Bob, what do you mean by piece rate labor?
Well, that would be all of the labor that goes into actually manufacturing and assembling that drill. DeWalt either does it themselves or they have a subcontractor that all the components come together. They probably buy most of those components, and then they have an assembly process. And most of those people are paid to do, they're paid, their cost may be $10 to assemble one drill. So they're able to itemize and understand what that is. They know what all the material, all the subcomponents cost. So that's your material, that's your labor. And I see you have on here freight. So that would be the freight that's necessary to transport the goods. And then almost everybody's going to pay a commission every time a drill is sold. They're either paying that to a salesperson, they're paying it to a rep group, or they may be having to pay it to a retailer for actually selling.
Multiple commissions. Yeah,
exactly. Tiered commission structure. So there's your total variable cost, $60. It doesn't include depreciation, doesn't include utilities, doesn't include insurance, administrative salaries. All those kinds of things are not critical at this point.
So the variable cost is $60. We sold it for $100. So $100, that's our sell price, that's our revenue, minus our variable cost of $60, gives us a contribution margin of $40. And, to make the math easy here, we've used $100, so that's also a 40% contribution margin.
Yes, and that would be pretty typical in this kind of industry as well. So that $40 then is used to cover overhead, to generate a profit. And it's also, if DeWalt, for example, wanted to get into a new market channel, they know they've got $40 there to play with if they needed to reduce that selling price in order to enter a new market channel. And then they could, based on their volume and their overhead, how many do we have to sell in that new marketing channel then to break even or to make the profit margin that we ultimately want? So it gives them pricing flexibility. If that number was much lower, they might want to look at, are there ways that we can raise our pricing to get a higher contribution margin? Can we reduce the material component somewhat? Can we improve our supply chain? Can we make our plant more efficient so that our employees are making more drills per hour or per shift, and our $10 labor rate goes down to $8, not because we're paying the employees less, but because we've helped the process become more efficient, and we gain that through efficiency. We might actually be able to pay the employees more because they're more efficient, and that's something that we like to look at as well, because the company wins, the consumer wins, and the employees win, and we like to go for those triple wins.
Bob, the way I always like to look at contribution margin, and we use this drill as the example, is I know that if I sell one more drill, that $40 contribution margin is going straight down to my bottom line. We talked about EBITDA earlier. This is a direct effect on your EBITDA because you're taking out those variable costs.
That's literally true. If your company is at break even, let's say DeWalt's breaking even. I think they're doing slightly better than that, but let's just say they're at break even, and they make one more drill, their EBITDA just went up by $40. So that's the power of knowing the EBITDA, because you know where that is and where your flexibility is in pricing. It points you to what you need to do from an efficiency standpoint. It helps you decide new marketing channels. But a lot of companies, a lot of businesses that we work with don't understand this. And most companies, let's face it, Davey, they're not one product companies. They have multiple products. We like to group them in product families, in business segments, so that we start understanding our business that way, and we start understanding contribution margin by those major components. Because invariably, if they're in 5 business segments or they have 5 families of products, one's going to be higher, one's going to be lower, and the other 3 are going to be in the middle. Well, how do we push another one to a high margin, and how do we bring that low margin one up at least to the average? So it helps us where we point our efforts. Where do we put our R&D? Where do we put our engineering resources? Where do we put our marketing resources? That helps tell us this contribution margin analysis is the first step in helping to make those decisions.
Well, absolutely, Bob. And on the sales side of the house, this is a conversation that we've had with a lot of clients. As you said, normally they've got multiple services, or if they're a retail or a wholesale client, they've got a whole line of SKUs, and that contribution margin can really vary across those SKUs. And if your salespeople do not understand what the contribution margin is for that item or that division, that segment, it really you can be putting your focus totally in the wrong place, because you're expending the same energy for a lesser contribution margin product.
Yes, and there's the law of unintended consequences, and that's why we say commission programs have to be set up to help motivate the sales force to sell the products and services that we want to, which tend to be the ones with either greater volume and contributing lots of margin dollars, or greater margins, so that we can push the company toward higher profitability. But we've been in businesses where the incentive was on the low margin products, and the sales force was doing a really good job, but we weren't making any money from it.
Well, that's the worst case. Worst case scenario is the incentives on the low margin products. I think what we see most often is the incentive is the same. Somebody said, hey, we're going to pay 5% or we're going to pay 10% commission because it seems simple and it seemed easy, but rarely do we see that as the the right way forward for many companies as far as their commission and their sales structure.
Yes, it's the curse of the average. And we're all for being simplistic about things and doing things simple and non-complicated. You know, we don't like 44-page commission agreements. It needs to be simple enough that it can be on 1 or 2 pages, but we don't want unintended consequences. And sometimes we motivate the sales force in the wrong direction because they're going to go where they can make money. Obviously, they're incentive motivated people, and we want them to be. But we need to decide where that is. Are we trying to build margin through volume? Are we trying to build margin through each individual family? And that gets into a lot of marketing questions about, you know, what segments do we want to be in? Where's the growth? What do we want the company to be in several years? Where do we want it to be a market leader, top 1, 2, or 3 in their geography? So this really helps us with that. But it's hard to do things on a across the board average. We never say do that. Because not everything's the same. So if you have different margins, you may need to have a different commission structure for different product families.
Okay, Bob, well, we've talked about the different parts of a financial statement. We've talked again about EBITDA and contribution margin. Now we're going to get into what I think is some of the very practical and more of the useful ability of the statement, and that is all these different ratios and analysis that we can gain from looking through a statement and pulling some numbers out. And I know we've got just a few here of some of your more frequently used ratios that we're going to talk about today.
Yeah, ratio analysis is very important. As you said, we've got all these statements, we've got all these numbers. Now we look at, okay, let's interpret that. What does it really mean? And where do we need to put some of our time, energy, and effort into improving our business? Because every business needs to improve continually. There are no perfect businesses, just like there are no perfect business owners or business consultants. So we want to constantly improve. This helps us focus where our improvements need to be. So these are 3 areas I always like to focus on.
All right. Well, first up, we talk about liquidity. What do you mean by liquidity ratios, Bob?
That's really what's our ability to turn things to cash. How liquid is the business? Is it all inventory and all accounts receivable and no cash? We can't pay our vendors even though we're earning money. So how liquid is our business? How can we turn that to cash? So one of the most common is this current ratio, which is simply our current assets, our cash, accounts receivable, and inventory, divided by our current liabilities, our trade payables, our short-term debt, those kinds of items. So we come up with a ratio of that. Those are easy to compare on the internet. You can go and look up your industry. There's lots of databases out there and say, okay, what should my current ratio be? We know it should be at least greater than 1. We should have at least enough current assets to cover our current liabilities. That says we're in a more liquid position. The quick ratio excludes inventory because inventory as a current asset is harder to turn to cash. It takes more time. So it's our cash and accounts receivable divided by our current liabilities. Again, our ratio should be greater than 1. A lot of companies, it'll be 1.5 or even 2 to 1. That's very healthy in most industries. Companies started getting into trouble having cash flow problems when their current ratio and particularly their quick ratio are less than 1.0. So we always want to keep that ratio above 1.0, which says we won't have significant cash flow problems.
Well, we've got an example here, Bob, pulling these numbers off the balance sheet. This company is definitely above 1.0 and appears to be a very healthy current ratio.
Yes, their current ratio is 24.2 to 1. So that's extremely healthy. As you see, they have a lot of cash, $328,000 of their $394,000, and their liabilities are only $16,000. Pretty unusual for a company to have that kind of cash or current ratio, but obviously they're retaining cash in their business. They're not paying it out so frequently to their owners. So that's an example of a very, very healthy current ratio. They're not going to run out of cash anytime soon on this size business.
All right. Well, up next we've got our break-even ratio, and Bob, this is exactly what it sounds like. This determines what that dollar amount is that we need to reach in revenue simply to be at a break-even. No loss, no profit, just break-even in the business.
Yes, and that's extremely important to know that and know how close you are to it. So the calculation is pretty simple. It's simply your fixed cost. Some people refer to that as the monthly nut. You know, what fixed cost do I have to cover every month, divided by my contribution margin, which is how much profit we're going to make on the next dollar of revenue. So fixed cost divided by that contribution margin percentage tells us what our break even is. I like companies to calculate that and divide it by 12 so we have it on a monthly basis so they know each month, are we selling enough? Do we have enough in our backlog? And are we shipping enough or delivering services enough that our revenue is going to be at least above our break even? And then are we managing our quick ratio and current ratio so that we have the incoming cash to cover all of our fixed expenses and our variable costs and at least break even for the month? That's the minimum standard.
Well, we've got an example here from our old buddy Joe and his bakery, and we can see Joe's break even. You know, so Bob, this means that Joe has got to generate almost $1 million a year simply to break even with his current fixed cost and his current contribution margin on his bakery items.
Right. And if we sat down and talked to Joe and said, Joe, how much was your revenue last year? How much do you expect it to be this year? Then we start to get an idea of, wow, he's easily going to cover this or he's not. So the scenario would be, if he doesn't think he can do that, can we trim those fixed costs? And can we increase that contribution margin? So do we increase contribution margin through pricing? Can we get into another market? Are there variable costs that we can take out of that? In other words, are his ingredients too expensive for what he's using? Does he have too much labor involved in it? You know, we don't know those kinds of things, but those are the questions to be asked. And on the fixed cost side, is his rent too high? Is he in a location that's not great for his business, but he's having to pay a premium rent? Does he have fixed costs on the payroll side for management, for administrative, for utilities that could be trimmed back in some way if his fixed costs are in fact too high? You know, in a bakery business, which is a very opinion business, it's a taste business, it's very subjective. And even though I mentioned ingredients, sometimes those ingredients, it's important to pay a premium for the ingredients to get the customer service and to get the taste and the repeat business that you want. But are there other things in there that can be trimmed back? In other words, are we getting value for what we're paying? So that doesn't say go out and buy cheap ingredients. It just says, are our ingredients matching to our pricing and to what our customers expect?
And lastly, Bob, we talk about turnover days or turnover ratios, and you can look at a lot of different line items and look at the turnover periods. You know, we've got the example here of AR, AP, and also inventory turnover days.
I think these are the three key ones. You know, how fast is our money coming into us from our customers? That's the AR turnover. How quickly are we paying money out? That's our AP turnover. We want to keep those basically in line. We'd like to be collecting faster than we're paying, but at least at the same drumbeat or heartbeat, the same rate, as we like to say. And then for manufacturers, wholesalers, distributors, inventory days is critical. So how many days does it take us to sell inventory? And how many times do we turn that during a year?
Well, let's take a look at that inventory here with our buddy Big Bill and his hardware store.
Sure. So we've determined that he has $2.5 million as his annual cost of sales. His average inventory is $575,000. So his inventory turnover is 4.35 a year, which just simply means that he's turning his inventory over a little bit more than 4 times a year, which converted to days is every 83 days. So it's a little bit less than 90. In a small hardware store, that's probably about average. So Bill, if he wants to do better, he's got to make sure that he's turning his inventory over faster. One way you do that is to not stock slower moving items, so that you don't have as much inventory stock. You stock the fast turn, not the slower turns. Is his pricing right? Is he being able to sell it quick enough? So sometimes you can adjust the pricing, and that causes your inventory sell through to be faster. But remember, every dollar of inventory is tied up in that business. It's either his money or borrowed money that's funding that. So that's why this inventory turns are important, because there's cash tied up in this business for all the inventory. The faster you can turn the inventory, the faster you're turning the cash. So people forget that fact that somebody has to pay for that inventory. And so the faster it turns, the better for profitability of the business.
Okay, so as we wrap up here, we've got some key takeaways from our financial statements. Again, we've talked about the income statement, also known as the statement of earnings, or even the P&L, profit and loss statement, the balance sheet, the cash flow statement, and then again, EBITDA and contribution margin. Bob, what are those key takeaways that if somebody gets nothing else from this, that you would want them to remember that they could take back and apply to their organization, utilize in their daily business?
Sure. On the income statement, that's the detailed version. So what are the 2 or 3 components on the income statement that need your attention? Is the revenue line flat compared to other years? Are your gross margin increasing or decreasing? Are your fixed costs, your selling, general, administrative, are they increasing or decreasing? And is that the right trend for you? And then, of course, obviously, your bottom line profitability. Most people go directly to the bottom line and say, well, I like this number or I don't. But what are the key drivers? The revenue, the gross margin, the fixed expenses. Look at those. That's where your action items are. The balance sheet, like you said, is a snapshot. So let's look at our ratios from our balance sheet, our current ratio, our quick ratio. Do we have enough liquidity? Do we have too much debt? Are we replacing our assets on a timely basis? The cash flow statement, again, do we have positive operating cash, and how are we spending that cash? Are we reinvesting in the business properly? Are we handling our financing properly? Do we need to be increasing our debt for growth? Do we need to be reducing it because we're not growing? The EBITDA and the contribution margin, neither one of these are GAAP measurements, as we've talked about GAAP a lot today, but they are critical to the business. Are we growing our EBITDA as we should, faster than the industry? And contribution margin, what's our profitability on the next dollar of revenue? And can we use that to engage into new markets and new strategies and increase the overall profitability of the business?
Great. Well, I think that wraps up, Bob, our financial statements 101. And of course, as always, we've got our contact information here. You can find us online, find us on LinkedIn, shoot us an email, give us a call. And, Bob, like we always say, we're happy to answer any questions from this presentation or any more specific questions that we can help you with on how these topics apply to your own business.
Absolutely. Thanks a lot, Davey. Appreciate it.